I avoid the wheel strategy at all costs. And a lot of you watching this are probably like I was when I first started options, and I was bought in by the wheel strategy and the promise of riches that it can make until it stopped working. That's what I want to cover with you today. First up, this isn't financial advice. This is just what I'm doing and have done based on my own individual goals and risk profile. Don't blindly copy strangers on the internet. That's how I got into my trouble with the real strategy in the first place, right? Do your own research, make your own decisions, get good at managing your own money. So let's cover today, firstly, what the wheel strategy is, why I avoid it, and what I do instead. Now, firstly, if you haven't heard of or joined the 50K Club yet, I would love to invite you. Essentially, the 50K Club is a place for options traders to create a consistent monthly income without needing to have a seven-figure account. Hence, the 50K Club. There are now 25 of us in there. The first 50 members will get access for just $50 a month. I'll leave the link in the description. I'd love to see you in there. Come say hi. So, let's get on into it. First up, what is the wheel strategy? It's essentially a cycle of selling put options in order to be assigned the shares. When we then sell call options, we have our shares called away, we sell put options again, and we circulate around this so-called wheel, right? That's the structure of it. It sounds very straightforward. It is very straightforward. It sounds very rinse and repeat. And that's where the problem lies, in that it's rinse and repeat until it's not. It works in basically a perma bull market with minimal pullbacks. But as soon as you get pullbacks that aren't minimal, or we flip into a bear market, or the stock that you're trading continues to trend down, it stops working and it hurts a lot. Here's some of the rules of the wheel, and let me know if you've heard these rules before. Number one, only sell stocks that you'd like to own long term. To me, that sounds good in theory, but long term is not trader. Long term is investor. And as someone who trades to earn income, I don't want my trading capital tied up long term. It defeats the purpose of it. My long term account, I buy stocks in to just hold long term. So the capital in my trading account, I don't want anything tied up. Number two, only sell at a strike you'd be happy to buy the shares. Again, it sounds good in theory. Let's take Palantir, for example, right? When we were trading up here at sort of 180 and above, who wouldn't want to own those shares at 170? You get assigned. We're now down at 107. And that's the problem, right? We don't want to own them at 170 anymore, but we've been assigned them because we wanted to own them long term at 170 when they were trading at 180, 190. But when the market turns against us, the wheel strategy works against us. Now, why do I avoid it? Is number one, getting assigned on your put option, it guarantees you're behind. It's effectively the only strategy that I can think of when it comes to options that kind of guarantees you're in a worse position than just entering the trade when you wanted to. Because the only way that you're buying shares at $100 is if they're currently worth less than $100. And I know it sounds simple when you hear that out loud, but for me, it took a minute for that to actually click in. I was watching my account be assigned to these shares, and I'm like, I'm always behind. Why am I doing this? You see, and the other part is selling a put at a level of support, because that's the other place where people tell you to sell a put option, right? It's at the support. But the only way, again, to be assigned means that you've lost that level of support And what do we know happens to lost support? It becomes resistance. So it's just becoming harder for us to get back into profit. Again, take Palantir, for example. This level kind of through here around sort of 153, that served as great support. Had you have sold a put at that level and you were assigned, you're now stuck with that being resistance, right? We're struggling to break through that. So potentially it means that you're also not getting out of these shares that you were assigned because we just never break through that level to get you back into profit. Someone in the 50K club mentioned this about the wheel strategy. I was reviewing my trades since the year started. I made 8,000 in contract premium and lost 7,000 from exiting assigned shares. I agree with Beck that the worst way to buy shares is via assignment on a cash secured put, right? So with the wheel strategy, if you're assigned on a put and the market continues to drop, either you're taking the losses or you're tying up capital. Either way, this I hear so often. Or, I mean, I was there too, right? So it's either I made the loss, like I took the loss, or now I got no money. Like, what do I do with all this capital that's tied up? If you've been there, I know I have. If you've been there, let me know in the comments if this is starting to make sense and if you feel like maybe you also have been caught out on the wheel strategy. Because now let's have a look at what I like to do instead. With each problem, there's a solution. I only enter a sold put when the next most likely move is up. We never know, but when I'm entering all sold puts with the expectation that the market will move up from the day I enter, I'm stacking the odds in my favor. So I do not have rules like we sell puts on red days or when a VIX is at a certain level. And I'm not entering when we're at support, because when we enter when we're at support rather than when we've shown we've bounced off support, then I'm setting myself up for the potential that we don't bounce off of that support and we lose it. So I'm always, always, always looking at the chart. And I'm entering when the chart is looking like we're about to move up. Rule number 1. And then I'm trying to avoid assignment on sold puts. 99% of the time, I don't want assignment. And if my strike gets breached, it ultimately means that the trade went against me, right? If we're trading at 110 and I've got a $100 sold put and I get assigned that because we're trading at 95, I only entered that trade because I thought we were going up, but we've come down. So fundamentally, that stock is different than when I entered. That market is different than when I entered. And realistically, I probably don't want those shares at that price because we're now most likely in a bearish trade. So I'm trying to avoid assignment most of the time. Now I'm entering all sold puts with the expectation the market will move up from the day. Oh, we did that one already. All right, rollability. It's a fun word, right? Before I enter a trade, I actually check to see what having to roll down and out would look like in case the trade does go against me. And some stocks aren't great for rolling, which means that you end up stuck. So for example, Amazon. Amazon is not a great stock to roll. You can't roll far. So I always check that first. If you want me to do a full video on how I actually check that, let me know in the comments and I'll put something together for you. But this is something that I look at before I'm entering a trade, right? And essentially what this allows me to do is roll down and out without tying up my capital for a huge amount of time and also giving myself a big gap between where potentially would be trading and where my new strike would be. Here's an example of what I mean. So I have a Soxal June 26 to 20 put, right? That's this one here. There's a good chance that this strike might be breached tomorrow. We've been hovering just above there over the last couple of days. I could have closed it today. So this is tomorrow, June 26th. This is tomorrow. I could have closed it today and locked in some profit and left open literally $200. But I thought, you know what? I'm just going to let it go. Why? Because it has good rollability. I can roll from this June 26, 220 all the way down to a July 10, so only going out 2 weeks, 150, and still receive a credit of around $280. So this is what I'm looking at. Now, who knows what Soxer will do, right? But I'm pretty confident that we're not going to get down to 150 by July 10. And if we do, then I can roll it again for more credit. Yes, I'm being caught up in the trade, but even 280 for this roll, it's a pretty good premium, especially considering what I've already received when I initially sold this put. So rollability is a huge factor for when I'm looking to enter my sold put. What about the flip side, right? Because selling call options, when done right, there's actually more money to be made than selling puts. The only time that this is not true is when you've acquired the shares from being assigned a put option. Because remember, we're already underwater. For us to get the shares at 100, it must be trading less than 100, which means that we're already selling our call option quite far out of the money. So instead, I'm buying 100 shares when the next move looks like it's heading up, right? Yes, that's when I'm selling puts as well, but when I'm more certain about that move. So the times that I'm sort of kind of certain, I sell puts because in case I'm wrong, I've got what I call room for wrong, right? The distance between where we're trading now and your strike, I call that my room for wrong. When I'm pretty certain that we're going up, I buy the shares. And then I will either immediately sell a weekly at the money call because that's got really good premium on it. And then if the stock moves up, amazing. I just let the shares get called away. Or I'm waiting for a move up first to lock in some capital gains and then sell at the money or slightly out of the money. And that's where the big money is. If I'm buying the shares at 100, I wait for a little move to 105, then I sell an at the money call. Maybe I get 200 for my at the money call and those shares get called away. I've locked in my at the money call premium and my $500 capital gains. That's a great strategy. And because I've chosen the right time to buy the shares, I'm not in a downtrend. This is the part that I can't say enough, and it's helped me so much in this strategy, is getting shares assigned on a put. We're in a downward trend. We have to be. Buying the call, buying the shares and selling your call when you want means that you've actually got control over when you're executing your trades, right? So either I'll just continue to roll up if I think that there's more upward move and my call is now trading lower than what the stock is, I might just roll it up for another week, or I'll just let the shares be assigned. But either way, as long as the trade's moved in our direction, there's not a loss to be had when your call is assigned. Key takeaways. Selling puts, a great way to earn money. Selling calls, a great way to earn money. Being assigned on a put, though, is the worst way to acquire stock. So for me, I treat each trade separately like it has to go up. So the biggest key for me has been act like you're a day trader, meaning only enter the trades when you think we're going up. And in doing that, it's going to save you a lot of bag holding because you're not trying to guess where the bottom is. You're not hoping that today's red day is the last day. You're actually making your trades a little bit more mindfully to all work out in your favor without relying on the safety net. I feel like it's a bit of a safety net. The safety net of it's okay if you get assigned, you don't lose. Because the worst case scenario is that you're assigned stock and you wait. But I think that with the wheel strategy is the problem if you don't have a 7-figure account, because you don't have the capital to wait. And a lot of the times your account is probably better off had you have just put it all in the queues and got your, 10, 15, 20% than having your account tied up in stock that is going down. So I hope this was helpful. Please, if you found this helpful, like the video, be sure to subscribe to the channel. If there's anything that you want me to go into more detail on, let me know in the comments. And of course, if you are ready to join the 50K Club and implement this in a way that works for your account, if you want to watch me live trade a 50K account as well, that's exactly what the 50K Club is all about. Or if you actually want to work closer with me, I have opened up my next round of mentorship. This will start in July, 20th of July. There's a maximum of 10 people per round. So it really does become almost like a bit of a one-on-one session each week for you. We go into all strategies in much more detail. We come up with plans for your account, and we just kind of work together to get everyone trading in a way that works for them. All right. Happy trading, everyone. I hope that this trading week has served you well. And there is no end. And that is all. See you next time.